Hey everyone, my name is Sherman, a CPA here at Life Accounting, where we help you save on taxes and increase your wealth. Look, today I want to help you do this by going over Biden's new tax plan and how it will affect your taxes, your money, and more importantly, what you can do to prepare for it. I have already spent hours reading through hundreds of pages of Biden's new tax plan, and I want to give you the top 10 ways that it may impact you in just a few minutes here. You know, we really don't get into politics much on this channel, but you should know the facts of these financial matters and how it will affect you and your family. And this tax plan will literally affect everyone if it goes into effect. There will be new tax brackets, new tax rates, new tax rules, new tax credits, and so much more. These new tax changes will affect how you invest, how you structure your business, and ultimately how you file your tax return to avoid overpaying on your taxes. So stick around until the end of this video for all of the details. And if you don't want to miss out on more ways to save and make more money, be sure to subscribe to our channel. All right, first, let me give you some context to what the Biden administration hopes to accomplish with their tax plan. On the highest level, they want to raise revenue and make the tax system more equitable. To raise revenue, they will raise taxes. Remember, taxes funds everything that our government does, from our military to government programs. And Biden wants to change several types of taxes in his plan, which you'll see here in just a moment. And to make the tax system more equitable and fair, they are going to be giving out more tax credits to people who they believe need more financial assistance. Remember, a tax credit is basically free money from the government and can even be refundable to you in the form of a tax refund. The Biden administration hopes to fix the wealth gap, and a major way they plan to do this is by changing the tax law to provide more tax credits and incentives for people who meet certain criteria. All right, so what does all of this look like? Well, let's go ahead and take a look. Here's a table that outlines the effect of Biden's tax plan by the Tax Foundation. This table shows the positive or negative effect that Biden's tax plan will have on people in different income levels. So if you are in the bottom 0 to 20% of income earners, then his tax plan is projected to increase your after-tax income by 15.9% in 2022. But if you are in the top 1% of income earners, your after-tax income is projected to decrease by 4.5% as a result of his plan. So basically, lower income individuals will benefit from his tax plan at the expense of high income earners for the most part. But regardless of which side of the spectrum you fall in, you need to know the specific tax changes coming and how you can best prepare for it. Whether it's to pay as little tax as possible or to increase your tax refund by as much as possible, you need to start preparing for these changes. So let's go ahead and take a look at the top 10 biggest tax changes in this tax plan and how you can plan for them. I'm going to start here by going over the tax hikes and increases in Biden's tax plan, and then I will back our way into the tax credits that those increases are helping to fund. And if you stay until the end of this video, you will see how these tax changes are expected to impact our economy. So if you're ready to ride the wave here, go ahead and click that like button for me below, and let's get this party started. All right, tax hike number 1. Raising the corporate tax rate from 21% to 28%. Now, this primarily applies to big businesses, as most small businesses organize as pass-through entities like LLCs, S-corps, and partnerships. But wait, before you celebrate here and think that this does not apply to you, let's look at how it does. First of all, if you invest in the stock market at all, then you are more than likely investing in C corporations, which means they will report less profits due to the higher tax expenses they incur, which may drive down the value of your portfolio. Secondly, if you are a consumer of any C corporation, then you may end up paying more money for the same goods and services that you use now. Remember, these are for-profit corporations, and they can easily increase their prices to pass this tax burden down to you as a consumer, which may contribute to more inflation. And third, if you are employed at a C corporation, then they may decide to reorganize their entire organization to maintain profitability, which could mean layoffs and less jobs in some companies. As you can see here, C corporations have many ways to deal with this tax change, including just choosing not to organize their business in the United States altogether. However, the Biden administration believes that this will be a simple way to raise revenue to pay for the additional spending that they want to do. I don't know about that, but let me know what you think about this in the comments below. All right, tax hike number 2, raising the top income tax rate from 37% to 39.6%. This is another tax hike to increase revenue for more government spending. But this would only apply to the top percent of income earners. According to Biden's tax proposal, this tax would only apply to married individuals with income over $509,000 and single individuals with income over $452,000. So you need to be earning some pretty good income for this tax to actually apply to you. But let's just say you do. Let's manifest this into reality for a second here. If you earn over $450,000 per year in income, well, how could you avoid this additional tax? Well, if you are a business owner, you can defer some of this income into retirement accounts like solo 401ks or SEP IRAs, which allows you to defer up to $58,000 of your income and not pay taxes on that amount. You can also shift income to other members in your family who may be in lower tax brackets by making them partners in your business. And if you want to learn more about how to pay less taxes legally in ways like this, then be sure to subscribe to our channel and check out my video on the top 6 ways to pay less in taxes. All right, let's go ahead and move on. Tax hike number 3. Taxing long-term capital gains as ordinary income. Capital gain taxes are taxes you pay when you sell assets like stocks. Long-term capital gains currently range from 0 to 20% depending on your income. And as we just learned, ordinary income taxes can go up as high as 40% for just federal taxes alone. And as a part of Biden's tax plan, he wants long-term capital gains to be taxed as ordinary income, but only for some people. Let's take a look at it. Biden is proposing this for taxpayers with taxable incomes that exceed $1 million in a specific tax year. So your capital gains would only be taxed at ordinary income tax rates if you earn over $1 million in a given tax year. Now, obviously, there are not many people who earn over $1 million every single tax year, but this can be a disaster for people who may earn $1 million in one given year. All right, just stick with me here for a second. Let's say you worked 30 years as a small business owner and now you want to retire. So you decide to sell your business for $1 million. Well, instead of paying the 20% long-term capital gains tax on that transaction, you would have to pay the ordinary tax rates on this amount, which would certainly be in the 39.6% tax bracket. So instead of paying $200,000 to Uncle Sam, you probably end up paying closer to $400,000 to Uncle Sam. At that point, you're basically selling your business to the government. In fact, in that case, you'd probably be better off selling your business for $999,000 instead of $1 million, because if you sell it for $1 million, then your tax rate is going to bump up to 40%. I also wonder if you could get around this tax by creating a separate corporation to own your business, which would lower the amount of income that you would have to show personally on your tax return. Anyway, let's move on to the next tax change here. Tax hike number 4, limiting like-kind exchanges to $500,000 in gain. Now, this tax change applies primarily to real estate investors. Basically, real estate investors do not pay any capital gains tax at all when they sell an investment and consequently buy another investment property. Normally, you would pay taxes when you sell a property and recognize it as a gain as you would a stock. But in this case, the IRS treats this event as an exchange because you're buying another property after selling a different one. So this allows investors to avoid taxes in this event. Now, the Biden administration wants to limit this to $500,000 for single taxpayers and $1 million for married taxpayers. After this threshold is met, then you would have to pay taxes on that excess amount in capital gains taxes. Though again, I'm wondering how this works if you own your real estate through multiple entities instead of you personally. I'm sure the wealthy will find creative ways to get around this tax. All right, tax hike number 5, applying the 3.8% net investment income tax to active business income. Currently, there is a 3.8% tax on investment income above $200,000 for single individuals and $250,000 for married individuals. Now, investment income includes passive income and portfolio income, like dividends, interest, rents, and all other types of income that are not subject to ordinary tax rates. Basically, this is kind of an additional catch-all tax to help fund programs like Social Security and Medicare taxes. Now, here's the interesting thing though. Businesses already pay a 15.3% self-employment tax on up to about $140,000 in income as of 2021. And the whole purpose of self-employment taxes is to fund Medicare and Social Security taxes. So why are they wanting to impose an additional 3.8% tax on active business income? Well, it looks like they want to close the loopholes that many business owners are taking advantage of to save on taxes, like escaping self-employment taxes through S corporations or investing in a business as a limited partner. So now basically the Biden administration wants the net investment tax to apply to all high-income taxpayers, which they define as earning over $400,000. So if that's you, it doesn't matter if you are passive or active in your business anymore, they want to tax you at the same rate for the net investment income tax. Which means that some business owners might have to pay thousands of dollars in both self-employment taxes and net investment income taxes. All right, tax hike number 6, increasing tax enforcement. Not only will there be higher tax rates, but it appears that the Biden administration also wants more audits, especially if you earn high income. They are asking for $6.7 billion to direct more enforcement against those individuals with high incomes. So again, if you earn over $400,000 per year, or you think you will at some point in the future, it sounds like you will be on Joe Biden's hit list. All right, so let's go ahead and look at where we are before we talk about tax credits. These tax hikes are expected to raise over $2 trillion in revenue for the IRS, according to the Tax Foundation. Now let's look at some of the places that revenue is going, which is where tax credits come into play. All right, so tax credit number 1. Expanding the Earned Income Tax Credit for workers without children. The Earned Income Tax Credit seeks to provide financial assistance to workers whose income are near the poverty line. The idea is that by providing assistance to low-income families, it encourages people to seek employment. According to Biden's tax plan, the Earned Income Tax Credit is just too small for workers without children. Therefore, he is proposing to increase the tax credit for workers without children. Now, under the American Rescue Plan passed in 2021, the Earned Income Tax Credit was significantly increased. As you can see here, the maximum credit increased by nearly 300%. This increase was intended to be temporary. However, Biden is now proposing to make this increase permanent beginning in 2022. All right, tax credit number 2, extending the child tax credit and making the refund permanent. This year, with the passage of the American Rescue Plan, the child tax credit was increased to up to $3,600 per qualifying child. Now, the sole purpose of this tax credit is to try to combat and reduce child poverty by supplementing the earnings of low to moderate income families. Now, the increased child tax credit was also supposed to be a temporary increase, but the Biden administration wants to extend the taxable years through the end of 2025. And not only would this credit be fully refundable under Biden's tax plan, but it would also continue to be paid out on a monthly basis, just like how it is right now. This was simply unheard of before this tax year, but it certainly will be helpful for families who desperately need this assistance. All right, so tax credit number 3, increasing the employer-provided child care tax credit for business owners. Like I mentioned earlier, if you are not the recipient of Biden's tax policies, your best bet might be to align yourselves with it. This tax credit is a good example. If you own a business and provide child care support for any of your employees, whether it is on-site or at an outside facility, you would be eligible for business tax credits. Biden's tax plan would increase the tax credit to up to $500,000 per year for business owners who participate in this. All right, tax credit number 4, making the new child independent care tax credit permanent. The Child Independent Care Tax Credit provides financial assistance to working taxpayers who incur child or dependent care expenses. Now, the purpose of this tax credit is to partially offset the cost of care that they incur. Now, normally, this tax credit has been limited to 35% of up to $3,000 in eligible expenses for one child or $6,000 for multiple children or dependents. But as a part of the American Rescue Plan, this tax credit was increased to up to 50% of up to $8,000 in eligible expenses for one child or $16,000 in expenses for multiple children or dependents. Under Biden's tax plan, he wants to make the increase to this tax credit permanent as well. All right, so now let's move on to the big picture here. Will Biden's tax plan be approved? And if it is approved, will it be effective? Most tax experts would agree here that it is highly unlikely that everything inside of Biden's tax plan will go into effect. But it is likely that something will pass, which will involve higher taxes for some people. So you should definitely start planning for the worst case scenario here. And as far as effectiveness goes, the reviews are kind of mixed based off of who you are listening to. But according to the Tax Foundation, the long-term effects of Biden's proposal will result in a decrease in GDP and a loss of over 165,000 jobs. Like I said in the beginning here, the tax code is a book of incentives. And these tax hikes will likely not incentivize some of the most ambitious taxpayers to continue to drive innovation, create more jobs, invest into real estate and affordable housing, and so much more. But also keep in mind here that Biden's goal seems to be more about promoting equality in our tax system rather than just increasing GDP. And as you can see here, the tax credits he wants to keep align with that objective. So comment below and let me know what you think, and I will see you in the next episode.